Hello friends, welcome to Easy Learning Economics. I am Dr. Kaval. In the previous lecture, we learned about GDP, GNP, NNP, personal income, national income, personal disposable income, various components of GDP. In this lecture, we are going to learn that three methods to calculate GDP. How to calculate GDP. GDP with product or value added method. How to calculate GDP with expenditure approach. How to calculate GDP with income approach. So in this lecture, first of all, we shall learn that how GDP is calculated, then how GDP is calculated with expenditure approach, what is the GDP format under expenditure method, what is GDP, GNP and NNP at market price, what is national income at factor cost, what is the difference between national income at market price and national income at factor cost, how to compute the GDP with income approach, what is the GDP format under income approach, and what are the difficulties with income method, and what is the GDP under product or output or value added approach, and we shall provide the examples of GDP calculation by three methods. So this is our lecture plan for today lecture. So we are going to start that how GDP is calculated. GDP is the money value of all finished goods and services produced in a country during a period of 1 year. So GDP is the measure of national income, national output and national expenditure. There are three methods to calculate the GDP. Number one is GDP with expenditure method. National income accounts are based on the idea that one person spending is an other person receipt or income. Under this method, economy is divided into four sectors. GDP is measured by adding total spending by all sectors, household, business and government in a given period. Mathematically, that can be expressed as GDP is equal to aggregate expenditure, and aggregate expenditure is equal to public and private consumption, government outlays, that stands for G, I investments, and NX stands for net export, we discussed in previous video also. Here the C is public and private consumption, that counts the purchases on the final goods and services including dry cleaning, haircuts and air travel by households. G stands for the government consumption and government investments including new roads, military spending, library books, etc. I stands for the gross private and domestic investment that is not used for the current consumption, include the physical capital and building new permanent homes or dwelling places. The NX here stands for the net exports, means the value of country exports minus imports. Here we will learn that how GDP format under expenditure method is shown. The equations for GDP, C plus G plus I plus NX. So this is the GDP at market price. How to calculate the GDP at market price? The format is that we add the public consumption, private consumption, government purchases, private investments and increase in inventory stock plus exports minus imports. By doing this calculation, we shall reach at GDP at market price. Now, how to calculate the GNP, gross national product, at market price? In order to calculate the GNP at market price, what to do? We have to add the net factor income from abroad in GDP. So this is the GNP at market price. How it is calculated? That firstly we calculated the GDP at market price, then we shall add the net income from abroad plus net factor income from abroad. It means income earned by Pakistani people from abroad minus income earned by foreigner in the domestic country. So by doing this calculation, we shall reach at the GNP. GNP stands for the gross national product at market price. NNP at market price can be calculated from GNP at market price. How? This is the GNP at market price amount. First calculate the GNP at market price, then less capital consumption or depreciation. Then we shall reach at the NNP at market price. This is the NNP at market price. After calculating the net national product at market price, Now we are going to calculate the national income at factor cost. This is the national income at factor cost. In order to calculate the national income at factor cost, what we have to do, we have calculated already the NNP, net national product at market price. Now we shall deduct the indirect taxes plus the subsidies. We shall reach at the national income at factor cost. This is the GDP format under expenditure method, in which we calculate the GDP at market price, GNP at market price, NNP at market price, and national income at factor cost. Now the question arises here, what is the difference between national income at market price and national income at factor cost? The national income before deduction of net indirect taxes is called the national income at market price, and national income after deduction of net indirect taxes is called the national income at factor cost. What are the difficulties under expenditure method? So the difficulties of this method is that items sold in market are considered, but non-market transactions are not included in national income. The second method to compute the GDP with income approach. Another method to compute GDP is by adding total income received by resource owner in the form of rent, wages, interest and profit. Income approach involves adding up the aggregate income earned during the year by those who produce that output. Aggregate expenditure is equal to GDP and GDP is equal to aggregate income. So it purports that the sum of all income earned by the resource suppliers in an economy during a given time period. What is the GDP format under income approach? So in order to calculate the GDP through income approach, what we have to do, as we know that the sum of the income received by the resource owner in the form of rent. So first we shall take the rent and other property income, then we shall add the wages and salaries before tax, and the profit and interest before tax, and the farm incomes or other mixed or unclassified incomes. So after adding all these things, we shall reach at national income at factor cost. What are the difficulties with income method? Following items are not included in under the income method. What are those items which are not included? That are the transfer payments. Transfer payments are not included. As we know that the transfer payments, it means these are the gift or grants from the government in the form of pension or old age benefit funds, or against which and no any exchange of good is taken or no any other economic activities performed. And other item which is not included under income method is increase in value of assets, because this is due to inflation and not due to the increase in output. And the second hand sale of goods bought and sold are not included in the income method. Following incomes are earned but not declared to authorities under income method. The unreported income, and other one is the illegal income. Illegal income earned through illegal sources is not recorded under income method. So these are the difficulties or limitations of the income method. What is GDP under product or output or a value added approach? The value addition means the value added by different sectors of production at different stages of production. Value added method is also known as output or product method. Under this value added method, output or product method, economy is divided into various sectors of production. Then net value of all final goods and services produced the year are added. So equations, we can say that national income is equal to value of final goods minus value of intermediate goods or services by all sectors. Value of final goods, the finished goods are those goods which are ready for sale. And the value of intermediate goods, it means the intermediate goods are those goods which are used for further processing or for resale purpose. Suppose farmer sells the wheat for ₹100 to miller, and then miller makes into flour and sell it to baker for ₹200, and baker makes bread and sell for ₹300. The value added by farmer is 100, and the miller has sold the flour for ₹200. So 200 minus 100 is 100. This is the value addition by miller, and by baker 300 minus 200 is equal to 100. Remember that GDP counts value of finished goods in order to avoid the double counting. We are taking an examples of GDP calculation by three methods. Suppose individual receives the following payments from the business sector in the form of wages amounting rupees 3,900, interest 400, rent 150 rupees, and profit is 550 rupees. This is the amount which is received by the individuals in the form of rent, wages, interest, and profit. 1,000 items are produced and sold to the household sector at an average price per unit of ₹5 rupees. Now, how to calculate GDP by expenditure method? As we know, the GDP by expenditure measures the value of final sales. So 1,000 product has been produced at the rate of 5 rupees. The total GDP is 5,000 rupees. Under the cost approach or output method measures the value added at each stage of production. So the cost of producing this output is also ₹5,000. How to calculate GDP under income method? As we know that the income method includes the income received by the resource owner. So sum of the income received by resource owner in the form of wages is 3,900, interest 400, and rent 150, and profit is 550. So GDP is also 5,000. So we have calculated the GDP by 3 methods, and that is 5,000. This is all about the calculation of GDP through 3 methods: GDP with income, product, and expenditure method. I hope it would be clear to all of you. So please let me know your feedback or any future request in comment box. Thanks for watching.